Welcome to Regulation Asia's video interview series. My name is Nick Wakefield, co-founder of Regulation Asia. Today we're examining the work of the Central Depository Services Limited, or CDSL, which was established in India in 1999 and has grown to become the largest central securities depository in the country. Over 25 years, CDSL has worked to ensure the Indian capital market is easy to access and operationally efficient for investors, contributing to the growth of the market and the Indian economy as a whole. Today, we have a very special guest with us, Mr. Nehal Vora, Managing Director and CEO at CDSL, to talk to us about the role of depositories and how CDSL has leveraged technology to modernize India's capital markets. Welcome, Nehal. Lovely for you to join us.
I would sincerely like to thank Nick for having me. It is truly a pleasure and honor to be on this series. Thank you.
Fantastic. Excellent. Okay, so to start, perhaps you can talk a bit about the role of depositories in facilitating capital market growth and what sets CDSL apart from its counterparts in other markets.
So CDSL has been in the forefront. We are one of the two depositories in India. It's formed from an act of parliament, or the Depositories Act, which got formulated in 1996, which gives recognition to create depositories. And India being a large country, probably the size of Europe, we always believe in having two large infrastructure institutions, especially in the space of the depository, so that there is a choice to the customer and there's a failover mechanism which is also built. CDSL, as you mentioned earlier, got created in 1999. The other depository, NSDL, got created in 1996. The interesting thing was that as soon as CDSL got created, there was real-time connectivity between the two depositories. And therefore, if customers could be on different depositories, but their transactions would go seamlessly through. This is to ensure that the customer has a choice, but the efficiency of the transactions are not lost. The second big decision which India made, which was different from the world, is that it started off on the premise of creating a segregated account structure as compared to the West, which was in omnibus structure. And most of the West continues to remain in an omnibus structure. Now, the intent of creating a segregated account structure was three principal intents. The first intent being that the customer has a choice, and the KYC and the unique identification of a customer is on a market-wide basis. So all assets are kind of segregated from the intermediary, and there is no commingling of assets which happen, which makes the customer protection of its assets far more powerful as compared to an omnibus structure. The second intent is if it becomes, in a sense, insulated from the bankruptcy or the insolvency of the intermediary. In case if the intermediary becomes insolvent or bankrupt, the portability of such accounts becomes very easy when it's on a segregated account structure, where it could easily move from one intermediary into another intermediary. And the third and the most important is that India has had the securities markets. It's the second oldest securities markets in the world since 1875. It was a physically traded market for a very, very long time, till 1996. So over a century. So people were used to having physical certificates where they can touch and hold these certificates. And to bring it akin to that experience is to have a segregated account structure where I can look and feel at my assets on a segregated account basis without having it seen in a commingled or in an omnibus basis. And therefore, the corporate actions, the holdings, the nomination facilities, etc., become extremely powerful, extremely segregated, and therefore brings in a higher amount of customer experience in terms of trust, as well as belief that its own assets are going to be safe and secure in this entire depository system. So that's been the three principal intents why we chose the segregated account structure. The second most important thing is on the cost structure. So India has always been on a per transaction cost basis versus most of the West being on a value-based basis costing structure. And that ensures that it kind of ties in with the segregated account structure presumption or foundation, such that every transaction is charged irrespective of the value on a similar basis. And it's a very low cost of transaction. This is to ensure that there is a deepening of markets, and also more and more people are able to join into the ecosystem where dematerialization becomes the norm. And I think that regulators, especially SEBI, has done a visionary role in this to ensure that all trading activity on a phase-wise basis moved from the most liquid to the least liquid, moved on a compulsory dematerialized basis. The second structural difference which we have done, which is different from the West, is that there was a segregation between the clearing corporations and the depositories. Most of the West, they have it as a single unit. But in India, we chose to have different institutions. This is to segregate the risk, the systemic risk of the market, where the clearing and settlement function is performed by the clearing corporation and the custody function is performed by the depositories. So that remains on an arm's length basis and segregated basis. It is the entire structure is different, the management is different. What is interesting is that the two depositories, NSDL and CDSL, are both connected to both the clearing corporations. So it is a many-to-many connect which happens. So a person can clear on a particular clearing corporation and have the custody in another depository, and it's all kind of seamless. So the buyer can be on one clearing corporation, seller can be on another clearing corporation. They can have a process where it can get now it can be seamlessly settled, and the depositories can be different for both these players. So that ensures that competition, healthy competition remains, so that the customer has a choice, and therefore that brings in efficiency and reduced costs. The third fundamental difference, where I think the depository ecosystem has really evolved in India, is that we have moved from the physical delivery instruction slips to a more of an electronic delivery instruction slip. And this is where CDSL has pioneered in the entire technology infrastructure and the foundation of creating. You do not need to be physically present at the intermediary or broker's office to transact. You can be anywhere in the country and yet have the same level of security and the same level of controls before such transfers takes place. CDSL has been instrumental in, under the guidance and leadership of the regulator, of creating a very different and unique system, which is called the eDIS, or the Electronic Delivery Instruction System, wherein when a transaction is taking place with an intermediary, it's a fintech solution. So it's electronically connected, but the authorization happens directly by CDSL to the ultimate customer without the intermediary knowing what that one-time password is. So it's a B2B business, but a B2C authorization. Now, this kind of a system does not exist anywhere else in the world. It brings in the efficiency of a B2B business, so that the distribution channels become economical, and the reach is very, very high. But the security of the customer being able to authenticate its own transaction without sharing that password to avoid any conflict of interest is directly with the depository. Now, because of this, the reach today, CDSL is in about 98, 99% pin codes of the country. And that's the kind of reach which we have, which is kind of one of the most widely spread distribution networks from a security standpoint. The other big initiative is on the pledge system. We have initiated something called a margin pledge system, which is also under the foundation and the guidance of SEBI as a regulator. What this entails, which is different from the world, is when you pledge, you normally have to transfer the securities to the person you're trying to pledge to. What we have created in the margin pledge system is that the securities remain in the customer's account, but there's a depository flag which gives the beneficial interest to the trading member in this particular example. So the customer cannot resell or repledge it to anybody because there's a depository flag which prevents it, but the securities continue to remain in the customer's account. So any corporate actions which can take place on those securities would continue to be enjoyed seamlessly by that customer without it flowing into the intermediary. Second is that the trading member can repledge it to the clearing member, and the clearing member can repledge either full or part of it to the clearing corporation. Now, this entire seamless flow, the customer has an entire audit trail of where its securities are getting pledged and repledged, and to the extent it is getting pledged and repledged. So there is a control and check which is being built in the system. Also, partial repledging allows it that it is not an all or none syndrome. It is based on the intent of how much needs to be pledged is only pledged. So, for example, I may pledge 1,000 shares to my trading member. The trading member can in turn repledge only 500 shares to the clearing member, and the clearing member can in turn repledge only 200 shares to the clearing corporation. When the invocation happens, it's the if the clearing corporation invokes out of the 200 shares which have been repledged in the example which I gave, only 100 shares if it invokes, then 100 shares directly moves from the customer's account into the clearing corporation's account. It doesn't go to the trading member or the clearing member. And if then the clearing corporation releases the 100 shares, then the CM in this example has about 400 shares, out of which if it invokes 200 shares, then 200 shares directly moves from the customer to the clearing member without going into the trading member's account, and so on and so forth. So what this brings in, it's a point-to-point connectivity and a direct credit on whoever invokes, and also an audit trail, and also the corporate action becomes seamless. So these are some of the very interesting reforms and nuances which has led to a stupendous growth which CDSL has witnessed. We were about 18 million in 2019. Today we are about 150 million plus accounts. And this is just about a very small percentage of the India's population. It's a young population. The interesting thing is the highest growth seen is in the age group of 18 to 25. So there are a lot of the Gen Z investors which are coming in. They like the fintech solutions because control remains with them, and that fits in with the culture with which they really trade. So these are some of the core reforms. Also on the electronic delivery instruction, it's only a block which happens when the sale happens, but there is a reconciliation done with the clearing corporation at each customer level. So for example, if I have a sale order of 500 shares, I need to give a pre-authorization to my broker before he transacts the order. So the process which I described earlier, where the one-time password is shared directly by CDSL to the customer and he authorizes, there's a block which is put of 500 shares on my account. Now, if that order culminates into a trade of 300 shares, it's a 500 share order, but it culminates into a trade of 300 shares. then my obligation is only 300 and it's not 500, though I have authorized 500. So at the end of the day, there's a reconciliation done with the clearing corporation by the depository as to how much is the obligation. And in this case, the obligation is only 300. So I will only transfer 300 shares. I will permit transfer of only, I mean CDSL will permit transfer of only 300 shares and not 500, and release the remaining 200 back to the customer. So this is what also brings in a lot of trust, because it's it's kind of controlled on a micro basis to ensure that the entire process is actually reflective of what the trade is and what the obligation is, and not even a single share moves beyond what the obligation is.
Okay, so obviously a great introduction there to kind of the role that you play in the market, and obviously, as you've mentioned, what sets you apart from kind of others, particularly in the West, etc. But in November last year, you guys were kind of recognised in our Regulation Asia Awards for Excellence for the Market Infrastructure Institution of the Year. Judges our side were highly complimentary of CDSL's technology initiatives, and you've touched on some of that already. But I'm interested, perhaps you can kind of expand upon some of these initiatives and how kind of the impact they're having on the Indian market.
Yeah, so I think where CDSL has embarked this journey on technology is about vertical scaling and horizontal scaling, both from an infra application and network point of view. That's business as usual, and security being the other side, where it has to ensure that its entire ecosystem is having the best-in-class security systems. The intent being that India is a retail-driven market. A lot of customers prefer to trade on their own. And there's an entire fintech revolution which has happened in India last 10 to 15 years, which has seen the growth of large fintech brokers, which were non-existent in the last decade. It's this decade which is seeing a lot of these fintech brokers growing significantly in size. Now, to really touch base or to keep in sync with the expectations of these fintech brokers, the APIs, or the application protocol interfaces, is what the entire ecosystem. So right from account opening to transaction to pledging to repledging to transmission to off-market transfers needs to be paperless and needs to have that same B2B and a B2C authorization framework, where the efficiency is on a fintech, which has a fintech flavor, but the authorization is directly with the customer. Now that causes many more people wanting to join the ecosystem. Also, the reconciliation, which I mentioned, between various market infrastructure institutions at a customer level is something very unique to the world. And that what creates a system which is more seamless, more in tuned with each transaction. And the infrastructure has to keep pace with a customer who wants to transact a single share versus a customer wanting to transact hundreds and thousands of shares. The level of precision, the level of sophistication, the level of security has to remain identical across both these infrastructures. And therefore, the infrastructure has to be agile and nimble enough to understand the requirements of a small investor versus a large investor, but should not compromise on the quality standards depending on the size of the transaction which is being committed to. So that, on a segregated account structure basis, makes the entire requirement of infrastructure that much more complex, more intrusive, but at the same time has to be precise enough to give reconciliation right up to the single share before any transaction goes through. Coupled with all this precision is the speed, because there are a lot of transactions in India, has one of the largest number of transactions happening in the world. So the speed of transactions cannot be compromised at the cost of the precision being ensured. And therefore, the infrastructure does not only have to be precise, but has to be fast enough to cater to the speed which is expected for this kind of transactions to go through seamlessly. Third is the settlement process has to be reconciled to the last share for hundreds of millions of transactions happening every day. And there's a very short period of time which is being given. Also, from a business continuity standpoint, we have a very robust framework to ensure that there are alternative sites, etc., to ensure that business continues as seamlessly as possible. So that's from the infra point of view. And from a connect point of view, you have intermediaries, which are large brokers, we have mid-sized brokers, you have small brokers. The infrastructure again has to be nimble enough to address the requirements of each of these intermediaries without compromising on their expectations. And their expectations are very different. So it's a union of all expectations put together from an infra point of view, which makes the process even more complex. But that's what really basically sets us apart in terms of how we've been able to garner this kind of volume, but continue to remain in the precision and sophistication as we move forward.
Okay, fantastic. You touched on dematerialization earlier. Perhaps you could talk a little bit more about the work you're doing there. What kind of asset classes are now dematerialized? And how has this streamlined account access in the Indian markets? And how has it helped reduce risk, enhance operational efficiency, and ultimately benefit investors?
So it's actually a very good question. India has been in a phase-wise introduction, but what has happened, it's a very definitive and uh, firm way of moving forward. So today, right from securities, that is shares, debentures, bonds, mutual funds on a voluntary basis, REITs, InvITs, all these assets are part of the dematerialized mode. And the demat account becomes kind of an electronic wallet of custody, which has all these assets which can remain in that wallet or coexist in that wallet simultaneously. So, what the customer gets is kind of a complete list of all its assets, and it ensures that the KYC is kind of common across all of that. So, it brings in that kind of efficiency in that. The nomination process becomes that much more powerful because it is an electronic recording of your nomination facility. You do not have to worry about the physical custody of these assets which you have, because those are on an electronic basis and can be retrieved at any point of time. So you do not have to maintain that much paper. The risk of fake, forged, and basically stolen securities is kind of out of the window, because all these assets are kind of maintained in a central repository by the depository. So the risk of that is completely really eliminated in these cases. Uh, Also, it creates a sense of financialization, where I can pledge various asset classes to create another set of asset classes. For example, I can pledge mutual funds to create a position in shares, or I can pledge my shares to create a position in mutual funds or in bonds. Now, that makes the process a lot more efficient, because then there is the entire multiple credit creation from a market standpoint, which gets created because the ability to pledge various asset classes comes in through a very seamless and secure mode. And that's what ensures that a lot more people are wanting to come and join the ecosystem that has seen the efficiency which it creates and the safety which it has.
Okay, so one of the most exciting initiatives to go, in line with what all the other kind of exciting things going on in the Indian capital markets, certainly in recent years, has been the shortening of the stock settlement cycle from T+2, sorry, to T+1, and then obviously T+0 for certain securities.
Yeah.
As more and more APAC markets plan a shift to T+1 settlement, can you talk about your work preparing for implementation of a shorter settlement cycle? What challenges do you experience and what do you learn, and how has it benefited investors in the market as a whole?
So I think SEBI was extremely intelligent in implementing T+1. T+1 was not an easy reform, and we were the first and kind of one of the first leading markets in the world to do it seamlessly.
Mhm.
What SEBI did was, and I think that's where the complexity of the infrastructure comes in, is that it did not move the entire market to T+1. It was a phase-wise introduction on a month-on-month. So it gave a lot of lead time to the market to prepare for the change which was happening. It started off with the least liquid, and it went on to the most liquid. It took about every month a few securities would move. Now, from an infrastructure standpoint, that brings in a lot more complexity because the infrastructure has to maintain both the T+2 and T+1 simultaneously whilst this transition is happening. But from an investor protection and from a market development standpoint, this makes it a very efficient way of doing it because then you're not giving those shocks to the market. You're allowing that kind of a seamless, phase-wise introduction of reforms which are happening. Uh, so we had to plan well to ensure that the phase-wise introduction, but the simultaneous T+2 and T+1 everyday settlements running on both these had to move seamlessly, and the commingling should not take place because finally the reconciliation has to be done to the last share. And that what brings in a lot more complexity. On T+0, it is on an optional basis, and there is T+1 and T+0. So both of them coexist simultaneously. It's the choice given to the investor on what settlement it wants to opt for. But the infrastructure has to be kind of adept. So both the clearing corporations and the depositories have to kind of be able to manage both T+0 and T+1 simultaneously based on what is the volumes in each. The intent is that it's giving a choice because as the settlement cycles reduce, the credit risk of markets reduce. So it brings in that efficiency, and also your money is released that much earlier. And unlike some markets where the security settlements was on a different settlement cycle and the funds settlement was on a different settlement, India has chosen to move both together. So it's T+1 for both funds and securities and T+0 also for both funds and securities to ensure that it's truly a DVP trade, which happens as we do each trade. And also, COVID gave us a lot more opportunity. One is that everybody, because of the national lockdowns, had to work from home. So the investors, the intermediaries, and the infrastructure providers like depositories all had to work from home. And that was a true testament that moving to a paperless system, the biggest dividend was markets could continue seamlessly without a single second of a glitch during COVID. And that showed a lot more participation coming into the securities market, especially in India. And that's also given other types of opportunities from a reform standpoint, that the shareholder meetings started happening on a video conferencing and depositories have been hosting these. So the concept of e-voting, which kind of took off in a big way during COVID, now we have something called a single sign-on for e-voting. So if I have 50 securities in my account, I just need to log in into my demat account and I can vote on each of these 50 resolutions of these different securities through my demat account, and it gets recorded through each shareholder, through each company. Now that leads to more shareholder activism. Also, the video AGMs or the shareholder meetings uh, help that shareholders which are not physically present in basically the location of the company head office can also participate in these shareholder meetings. So a lot more participation happens. People even traveling or staying in different countries can now participate in the shareholder meeting. So this is another area where CDSL as well as NSDL both have been instrumental in ensuring that the shareholder activism goes to the next level.
Some obviously some very exciting initiatives there, both across the Indian market and with the CDSL. But where do you go from here then? What are your priorities moving forward, and what other initiatives does CDSL have planned for the next 12 to 24 months?
Yeah. So I think our core remains that investors should be empowered and investors should be educated, because true product suitability happens when an educated investor chooses well what is suitable for itself. So, can an investor trust its own behavior and conduct in the present so that its future remains safe and secure? And that for me is the cornerstone of having a resilient market. So, for us, investor education is going to be one of our core focus areas where we would like to uh, speak the normal language. We have something called a consolidated account statement where all assets are consolidated and sent directly to the investor by the depository. That we have extended to 23 languages in India. So you do not need to only be in English. You can have in regional languages. So it's a social inclusion agenda of CDSL also. Uh, we are also developing an investor app where all your transactions can be directly be accessed on a real-time basis across all your demat accounts. If I have multiple demat accounts, I can see my holdings across. I can pledge, I can nominate, I can do all the activities, but it's kind of a B2C information flow happening through the app, is to further the agenda of investor empowerment, uh, to allow the investor to make its own choice and become self-sufficient, so that it is what I truly believe, it's my personal belief, is an educated investor is the empowered investor. So what can we do to further this cause so that the market becomes far more safer, uh, basically resilient, and the trust in markets grows with every passing day? Second remains, we want to continue to build on our technology landscape to bring more efficiencies to the intermediary sector, to the issuers, to the issuer companies, and to basically the investors, to ensure that the entire journey is seamless. It's kind of ensuring that I see what I get, to put it in very simple words, and at the same time have the precision to ensure that everything that I need is seen by me. Though I trust my intermediary as a investor, or I trust my investor as an intermediary, but there is something to validate for me directly with the point of truth. And that becomes the cornerstone of ensuring that you trust, but you validate at any point of time. So that's going to be our two focus areas. Obviously, newer products, asset classes coming into the fold, because the entire journey, the entire primary market has seen a lot of reforms. The IPOs are now completely on a dematerialized form. So that has also reduced its timeline in terms of credit to the investor. We've recently implemented direct payouts. So securities which are settled go directly from the depository into the investor's account. It doesn't go to the intermediary's account. So that is again building on the trust. So it's moving in a way that a lot of empowerment is given to the investor, and therefore now the responsibility of the investor to ensure that it is educated enough to make the right choices for itself to ensure that its future remains secure.
Fantastic. Finishing it off with talking about investors and trust and education. Great way to wrap things up. Excellent. So many thanks, Nehal, for talking to us about CDSL's work. For more information on CDSL, you can, of course, visit www.cdslindia.com. And as always, keep track of regulatory developments for Asia Pacific financial services. You can visit Regulation Asia at www.regulationasia.com or follow us on LinkedIn or X. Nehal, it's been great for you to join us today. It's been fantastic to learn about CDSL's work and to understand the Indian markets in more detail. Thank you once again.
I would also like to thank you, Nick, for your time and also your team's time. It has truly been a pleasure and honor to be with you. Thank you.
Fantastic. Thank you. Have a good day.
Have a good day. Thanks.